HDFC AMC is the other one which should come up on your screen. It's taking a big knock. HDFC, I mean AMC, the company yesterday in an exchange filing told markets that they're providing about 500 crore rupees to provide liquidity to the unit holders of FMPs, their FMPs, which essentially have exposure to the SL Group companies. Now, in a way, HDFC AMC is saying that we're going to make debt investors whole again, but using shareholder money. There is a fair bit of debate on this about whether this is the right thing to do, whether you need investors' approval for this, shareholder approval for this, and whether this kind of sets some sort of a precedence. Dhirendra Kumar is CEO of Value Research and he's joining us to answer some of those questions. Mr. Kumar, thank you for your time. Your first thoughts on this issue?
No, I think that is, prerogative of the management. And they have done which in their wisdom seems not a very risky bet. The likelihood of recovery of money, and it's of course it's shareholders' money, and mutual fund is a business of reputation. That will definitely give HDFC a great different advantage. It will be an advantage. It will be a situation where it will not be. It's very hard to replicate the same action for other companies. That part, I think there will be a regulatory angle to this. The regulatory angle is that whether the company was right in not exercising the ability to sell the collateral, or whether they were supposed to, even do the lending based on those collateralized external collateral to that particular fixed income investment. So that I think they would have. We are not aware of the precise details, but that I think will be the primary driver.
Okay. Mr. Kumar, do you expect other companies to probably replicate this as well?
No, not unlikely, because if you look at it, there was in FMP, there were two situations. One was faced with Kotak and the other was faced with HDFC. Kotak was able to redeem substantial part of the realizable value of the investment, and the rest of it has been kept for those investors as and when they become realizable. That will be paid off. In this situation, the FMP was extended, and that I think was not appreciated by the regulator because extending the tenure of the FMP at its due maturity was something which would have been one of the contentious issues, and that is what it is translating into. One has to see that whether it is going to be a real liability for the shareholders, whether HDFC AMC will lose its money. That's only in the realm of the future.
Right. I just want to put out some, Mr. Kumar, just reading out some tweets put out by this is, I think, Sanjay Bakshi, which we were going to put out. Yes, I mean, he's a professor at MDI in Gurgaon, and this is what he's tweeted. The AMC should take approval of its minority shareholders for this charitable action. If the majority of the minority shareholders approve, then there should be no objection. The AMC has net worth of about 3,000 crores and 500 crores is significant exposure. Plus, once they do this, there will be demands for future bailouts too. Lawsuits even, it's a Pandora's box, really. I mean, just posing that to you without a comment, Mr. Kumar, how would you react?
I agree with him that, this is going to be a Pandora box because this raises expectation. Mutual fund is supposed to be a pass-through. But this is an extraordinary situation in the sense that, and it has happened in the past too. It has happened in a few situations where AMCs were asked by the regulator to take it on their books. But undoubtedly, mutual fund is a pass-through, and that does not happen in equity fund. That does not happen in fixed income fund. In fact, the regulator has enabled the side pocketing, the segregated portfolio mechanism. If something goes wrong, how to make it, how to ensure continuity of a fund and ensuring the interest of all three kind of investors, the new investors, the existing investors, and the prospective investors. This definitely, I think the regulatory angle which I was mentioning too, that might have prompted HDFC to deal with it differently. Also, it's a matter of, subjective evaluation. Mutual fund, fixed income funds in India is a very unusual animal. Every fund company provides liquidity, instant liquidity, or reasonably instant liquidity. The underlying is completely illiquid or reasonably illiquid, and what investors get or experience is absolute. Get your money anytime with whatever be the business rules. Liquid funds, you get it next day. So in that sense, there is a disconnect. There is a disconnect between the underlying and what investors experience.
Mr. Kumar, do you think that regulators could probably get involved at some level to question these standstill agreements which have been entered with, say, for example, SL in this case, in order to assess whether there is that validity? Because at that point in time, they had the option of selling those pledged shares. But because of the standstill agreement, this is the next step that they had to take, which is obviously not in agreement with probably majority of the minority shareholders.
Yes, regulators have gone on record. In fact, it is now in the public domain that HDFC was asked questions or asked to explain what prompted it to act the way it did.
Fair enough. So just to kind of sort of go back to a point you made earlier, in a way, this is righting an earlier wrong with regards to extension, which HDFC undertook earlier.
I don't know, possibly. But, these are ambiguous things. These are first-time situations. A lot of transactions happen. It's a fairly routine, normal situation. Only when a credit turns bad that we ask these questions, or these things come on the forefront. Otherwise, they will just go unnoticed if the bond is, retiring in the natural course. Yes, these are ambiguous things, and this situation will prompt regulators as well as fund companies to ask questions and articulate the game plan from here on, which is legitimate and acceptable to all.
And of course, there is also the question of making an assessment about what is the eventual loss going to be on the exposure and whether this is entirely recoverable and this is a temporary provision, Mr. Kumar, right? I mean, the House would have made that assessment.
Yes. Yes, going by what the news report, there is a underlying, there's a collateral, there is extra collateral of the entertainment. The situation is that even our equity markets are shallow. If everybody turns up to sell their stock tomorrow, one day we saw that a small stake was being sold and the stock went down by 10%. We have seen it in numerous situations where promoters pledge shares, a small part of it being sold. Triggered by those, as and when the bankers sell it, we see inordinate decline. So that will actually translate into a permanent loss. This requires, this is actually negotiating a bad transaction or a transaction which has not gone as per plan. And this just might require time than an absolute loss, because I realize that, even today there is a news that, something worth 2,000 crore worth of solar assets being negotiated and sold to Adani by SL Solar.
Okay, well, yes, hope floats. But Mr. Kumar, just leave us with your thoughts on whether you think that many of the companies, mid-caps especially, could probably be impacted now simply because of possible sale of, promoter pledged shares in fear of maybe repercussions such as SL Group in terms of what we're seeing. Do you think that there could be significant pressure in terms of these mid-cap companies where ratings have been downgraded as well?
No, these are two different things. Pledge share is definitely a short-term threat, but the underlying business matters. The performance of a business, earnings being the key driver, that is the primary driver of a company's prospect. The other part is, companies getting downgraded. Yes, we have clear symptoms that rating agencies have gone into an overdrive and have become hyperactive. They have been questioned by the regulators, and now I find that the pace of downgrade is unprecedented.
Mr. Kumar, thanks very much. Appreciate you joining in, and thank you for that perspective. So, Dhirendra Kumar at Value Research of the view that it's good for the reputation, for the business reputation, and at the end of the day, investing is essentially all about reputation. So, in that sense, for the business, this is good news. and shareholders will eventually perhaps follow. Right now, there is a cut, 5 or 6%, so the market clearly doesn't sort of like the use of shareholder funds for the purpose of making FMP investors whole again. I mean, essentially providing that 500 odd crore rupees against that exposure. Okay, we'll sort of come back to this topic, get you more perspective. We will take a quick break. We come back and discuss what's the price of oil going to do. Manisha Gupta will be with us, and she'll be speaking with Pradeep Rajan of S&P Global Platts. That conversation follows in just a bit.